Good morning. How's it going? This is the 0DTE morning market analysis. Decided to go with a theme from going forward here with all this wonderful lighting that I have. So when you see the color, you might get a hint on where my bias is towards for that day. But today, as you probably saw, the title of the show was, hey, is this a dead cat bounce? A classic dead cat bounce after this 10% correction? Or are we starting a new leg up, right? So maybe the theme will tell you what I think, but it doesn't really matter what I think. It really matters what actually happens. So we're going to get right into it and talk about today's setup and how we're going to prepare for it. And so what we're going to do right now is we are going to go to the charts. That's not the chart. All right. So we're going to go down to trading view. It always happens. That's because I don't set up in the morning. But here we go. All right. And we always start off with the VIX right here. And we get our temperature for the morning. We're looking for the level of volatility because that will tell us where premium is in its decay for today's 0DTE trade. And when VIX is high, that means there's decelerated premium decay or inflated options, and that creates a much more favorable environment for our butterflies. When volatility is low, that increases the rate of premium decay, and then that does not inflate but pulls out premium out of options, and that makes butterflies in our out-of-the-money trades far more expensive, forcing us to go to much narrower widths and reduce our exposure to the market. But that's not the case today. We are still nicely inside the Goldilocks zone. Yes, we're at the lower third of it, and that's fine. It's still Goldilocks. That means that we're looking at Goldilocks 1. We're between 25 and 35 wide. Then we need to sort of narrow in on where on that scale that we are based on that level of VIX. And this is after thousands and thousands of trades that I've kind of determined this. And, this is all subject to change, of course. So over the past 3 or 4 months, I had all of my width ranges about one strike lower. And so I adjusted them all based on this sort of new awareness after trading, 3 or 4,000 0DTE trades over the years. I found that the ranges needed to be upped, so that's why you see them here. And if you go back and check some of my previous shows, you'll see that the ranges were a little bit lower, a little bit more conservative. Now I'm opening up. So our next thing is to take a look at the big ass fly to see, because that's what we're using that as a gauge to figure out exactly where in that range that we are. And so that means going to think or swim. And that's what I'm doing. You see it right now. You can see that here's an at-the-money fly. Well, it's not really at the money. Since I put it on this morning, the market has actually moved up a bit, so about a strike. So let's just fix this by kind of meeting it where it is and just increase the strikes for each of the legs of the fly by 1. And that should put our center strikes right at the money and give us a reading of where the fly is. So that looks pretty good right there, right? Yeah, look at that, 57.85, right on that center strike. And the price of the fly this morning is just under 20, 19.75 or so. All right. So then we go back to our VIX playbook in TradingView. And there we are. And we can see that 20 is right in the middle. So we're at 30 wide on that range. Maybe a little bit leaning this way. I tend to lean towards the upper end, but 30, 35 wide. Let's call it 30 wide this morning. So that's pretty aggressive. That means that our out-of-the-money butterflies, using our 10% debit rule, meaning that we should never pay more than 10% of the width of that fly. So if it's an SPX, that means we shouldn't pay more than $3. That comes out to about $300 or so. We try to get a little lower if we can, so we can get a little bit better risk to reward ratio. A lot of people look at that and say, man, that just seems so far out there. Price is never going to go out there. Well, if that were the case, we would never make money, would we? So you're wrong. But it is the case. And it gives us the perfect sweet spot of where we want to be. And if you've seen my performance, as I showed, I don't know did I show that last week, but I'll go over that in another show, showing you my Sharpe ratio. My Sharpe ratio consistently is in the mid fives. Actually, right now it's about 5.05, but my last account it was way up there, 5.87. That represents elite institutional caliber performance. All right. Now, I'm not trying to brag here. I'm trying to tell you that this strategy, if you follow it correctly, follow my tutelage, my coaching, you will be able to perform at elite levels, whether you consider that elite hedge fund levels or institutional levels, you will be able to do that as well. And if you want to learn how to do that, then go down below to the link in the description where you can start off by joining our 0DTE Academy and learn our strategy, our process, and our methods. And you too can get out of the quagmire that you're currently in with your trading, because I know for a fact that 98% of all day traders lose in any 3-year period. They're just big losers. And if you go to any 1-year period, sure, you can get lucky, but most people are never achieving consistency. You want to learn how to get out of that mud pit, that tar pit of trader death, then go down below and join the Academy. It is the best value anywhere on the internet. Sorry for such a long plug, but hey, you got to plug things that will help you. Anyways, we're going to move on with our analysis. And the next step is to go and look at our directional bias. And that's really what we're here for, right? And we can see after a 10% downturn, correction, one of the bigger corrections that we've had in this long-term bullish trend, we are now starting to move up, and we're well above the moving average. This is the Hull moving average, set at a 21-day on a daily chart. And basically, I determine directional bias. It's either above the Hull or it's below it. Above means long call flies. And you can see not only are we above it, but it's Monday. This little hammer-looking thing here was Friday. So we've actually gapped up, right? So our directional bias is bullish, meaning we're going with out-of-the-money long call flies that are 30 wide. So we already know we're halfway there in terms of what we want to do for today's disposition. We also saw that the big-ass fly was well below our limit of $25 debit, meaning that anything under $25, we consider taking that big-ass fly if there's an economic report that could potentially, set up the big-ass fly for a quick profit. Now, there aren't any pre-market economic reports, but there is an economic report that's coming out at 9:45, just after the market, so we'll look at taking that big-ass fly before that. There's no other reason to take the big-ass fly other than if there's an economic report. You got it? Right? Because we're looking for that volatility crush event that happens right after that report to give us that quick injection of premium decay. All right, so there we are. Next step is to look at our structural analysis to figure out exactly where we're going to find that entry event. Entry events, because we're bullish, we're looking for a pullback into a structural level, which are determined by the volume profile. And we do this pre-market analysis. We do it on a weekly basis, update our volume profile so we know where all the levels are. That's where you can find support and resistance, liquidity, illiquidity, transition zones, all of that sort of thing. And that's what we're all set up. And these vertical lines are showing the morning session because that's where we're looking for the opportunity. You can see on Friday, we actually had 2 different opportunities where we found divergences right at this structural level at 56.65. You could have taken a trade here or a trade here and put an out-of-the-money butterfly. And as you can see, if you had put a butterfly up above, you would have made bank. Yes, which we did. So we're looking for something similar today. With our bull bias, looking for a pullback into one of these structural levels. We just entered into a volume node, and I indicate that by putting a different color for my structural levels. You'll see green and red outlining the node, and that means that we transition through a gap. Here was the top of the previous node way down here at 56.51, and now we're up. So the bottom of this node is at 57.47. So that was a pretty big gap up from here to here. And now we're going to be opening the market up way up here, right? If we were going to take a look at the big picture analysis of this, let's see if we can bring that in. Look at a day chart. I didn't have this planned out, so it's a little bit after the fact. All right, so there it is. So yeah, so let's take all this stuff away, all these lines. And we can see that we've just made our way into this node right here. It's a little difficult to see, but we transitioned this big gap right here, and now we're making our way into this node. So there we are. Yep, there we are. Let's see, we're ES1. Okay, so there may be a need for an adjustment to this. I don't know. Let's find out. Because we just switched over to the June contract, sometimes your settings can be a little bit... So it says adjust for contract changes. I don't know. Do we want to adjust for contract changes? We'll take that off. See what happens. Come on, redraw, redraw. Come on, let's go, let's go. Yeah, it doesn't want to redraw. There we go. All right, so now we're showing it correctly. We spun this gap since Friday. We went most of the way through it. Got through this sort of child node that's down here. Now we're into this node, which is bounded by about 5730 something and 5790 something. And now we're getting to the top of this node, and there's another huge volume well, and that represents illiquidity. And it's very possible, if we have the momentum, that we could easily just zip through that today. And then that will create even more momentum, and then sort of launch us like a planetary slingshot and bring us even higher. That's why I think that we are definitely on a bullish track here, and we're going to recover from this correction. So now you know what I think. Now what happens may be a completely different story, because what I think doesn't really matter, and the market doesn't give a damn what I think at all. All right, so back to the big head. So there you go. Yes, I'm saying green, and that's really just for today. I think in the long term, it looks like we're going to continue up. This is not going to be a dead cat bounce, but if I'm wrong, then I'll have egg on my face. If I'm right, I'll look like a hero, but we don't trade in the future. We only trade in the present, because we are zero DTE traders. We trade the day. Seize the day. All right, there you go. That's my market report for this morning. I hope you all have a great trading week. Again, don't forget about the Zero DT Academy down below. That's your first step into ascension, into my coaching program. You want to learn more about it, go to zero-dte.com. Zero-dte.com. You must have the dash. If you don't have the dash, and then it's trash. Zero-dte.com. Learn all about our methodology, our coaching program, our school environment. Learn about the strategy, learn about yourself. You'll learn a lot when you go to zero-dte.com. I wish I could just plaster it up here. I should do that next time. Just put it right up there. But I think with the what do they call it? The captions. It should put it up there, I hope. All right. All right, everybody. I'm a little hyped up for today. I am just energized. Hope you are too. Coach Ernie, out.